Today, I want to debunk 4 common credit score myths that could be costing you hundreds or even thousands of pounds. And stay tuned to the end where I reveal the most common myth that could be stopping you from making big savings. Hey guys, welcome to the channel where we help you make sense of your finances. Before we dive into the myths, we should discuss what a credit score is. A credit score is a prediction of a credit behavior, such as how likely you are to pay back a loan and if the payments will be made on time. All of your credit behavior is recorded over time into a credit report. Then it's chucked into a mathematical formula called a scoring model, which then spits out your credit score. Why is a credit score so important? You can leverage great scores into great deals on loans, credit cards, insurance premiums, renting a property, and taking out a mobile phone plan. Having good, or even better, an excellent credit score can provide massive savings over your lifetime. Let's use credit cards as an example. And you might be thinking, well, I've been accepted for a credit card, so I must have a great credit score. But did you get the best deal? The terms and conditions of your credit card deal is determined by your credit score, such as the credit limit you'll be given. The better your score, the bigger your limit. The length of the promotional offer. The better your score, the longer the lender will let you stay on that promotional offer. And the promotional rate itself. The better your score, the more likely you will get the advertised rate that made you apply in the first place. Combined, these things mean that you can get the best loans on larger amounts and for longer if you have a good credit score. Now that we've clarified those things, let's get into those common credit score myths. Myth number 1, checking my credit score would affect my credit score. Turns out, it doesn't. Checking your own credit score is considered a soft search and has no impact on your credit. It's only when lenders do a hard search that can potentially lower your score. Doing too many hard searches within a short time frame will negatively affect your score. It's a good habit to keep an eye on your credit score so that you can take action to improve it. Myth number 2, I have one credit score. No, there isn't one universal credit score to rule them all. Each credit reference agency, or CRA, will give you a different score on their own different scale because they use their own scoring model. The largest CRAs in the US and UK are Experian, Equifax, and TransUnion. Myth number 3, being in a relationship links my finances. Being in a relationship doesn't mean your credit report or finances are automatically linked. You might even be married or in a civil partnership, but your credit score is still single and ready to mingle. The only times your credit scores will be linked are when you apply for joint credit, such as applying for a mortgage together. Be warned that if one of you has bad credit, your application could be rejected. So do that soft search credit on yourselves first to get the full picture. Now, if you have taken that credit with someone in the past, but no longer share any joint accounts, it would be a good idea to remove the financial connection. Removing a financial link between you and another person is called financial disassociation. And you may need to do this with multiple credit reference agencies, but it is worth the effort to ensure you are no longer affected by their credit behavior. And now, for a common myth that has a big impact on your credit score and therefore affects the deals you get access to. Myth number 4, closing credit cards will improve my score. No. Closing credit cards will actually lower your credit score. This is because it will reduce your credit utilization ratio. A credit utilization ratio, or rate, is a percentage of credit available to you versus how much credit you are using. Let's work through an example. You have 3 credit cards. Card number 1 has £5,000 of available credit. Card number 2 has £2,000 of available credit. And card number 3 has £3,000 of available credit. So in total, you have £10,000 of available credit across 3 credit cards. Now, let's say you went on a spending spree and maxed out cards 1 and 2. You are now using £7,000 of your £10,000 total available credit, which gives you a utilization rate of 70%. Next, you decide to close card number 3. It has zero balance and you don't use it often. And you're trying to streamline your finances, which makes sense. However, this takes off £3,000 of your available credit, meaning that you are now using £7,000 of £7,000, giving you a utilization rate of 100%. Your credit utilization rate has just jumped from 70% to 100% without you spending a single extra penny. This makes credit reference agencies believe that you are maxed out and you have no wiggle room for any emergencies and therefore could default on your payments. This myth requires you to take no action at all to improve your credit score, and that's why I now have a collection of credit cards that are just gathering dust. So there you have it, 4 common credit score myths that could be costing you hundreds if not thousands in savings. I hope I've helped you to make sense of credit scores so that you can make smart financial decisions. If you found this helpful, hit the like and subscribe button and check out our other videos for more financial tips and guides. Thanks for watching and see you in the next one.